Welcome to the Broken Pie Chart Podcast, episode number 28. I'm your host, Derek Moore, and today we're going to be touching on a couple things around volatility and options, how options or do options right before a stock reports earnings. Do they tell you anything about the potential direction or how much something will move post-earnings announcement? And we'll just touch briefly on the VIX or the VIX Index. Of course, give you some links into at the bottom of the show notes in the episode, so make sure you're reading those. And I'll start out with the idea of the VIX. So the VIX Index, VIX, if you've ever gone into a restaurant or you're sitting in an office or you're watching at home and you turn on CNBC or Bloomberg or Fox Business, right? They're going to show you the ticker across the bottom, but they're also going to show you what the S&P 500 is doing, what the Dow Jones is doing, what bond yields are doing. But they're also going to show you something called the VIX or the VIX Index. And the VIX, what that does, and the Chicago Board of Options Exchange, I believe, is the purveyor of this, and they do the calculations. But the VIX measures really the 30-day options on the S&P 500 index. So that's the underlying. And it looks at, the underlying calls, the underlying puts, right? And looks at how robust or the level of premium. In other words, what are people willing to pay for these options? And so VIX is a measure of volatility vis-a-vis options premiums. And the idea is that, and a lot of people call this the fear index. And the reason why they do that is because the VIX tends to rise when you have market sell-offs or panics or any type of stuff that's going on in the market. And it tends to be very complacent, very low when you don't have much movement or volatility in the market or much fear in the market. Now, the reality is it's not a fear index. It's not measuring fear, but what it's measuring is how robust premiums are on the S&P 500. And so to give you an example, I pulled up a random date. There's a website called VIX Central. I'll, of course, link to it in the show notes. But you can pull up VIX Central and you can actually go and see the term structure or see what the VIX was not only today, but you can also look at it back in time. And by the way, I will talk a little bit. Somebody asked me today, hey, I heard them talking about a inversion of the VIX curve. Is that the same thing as the inversion of the Treasury yield curve? So I'll talk about that. But just for reference, just looking at October 16th of 2008, and so that would have been in the midst of the financial crisis. The VIX future, the nearest month, was at 63. To put that into perspective, the VIX today, even with a little bit of a sell-off, I believe the VIX, and by the way, the VIX has been fairly low. It closed around 19.3, which is higher than it's been in some time. To put that in perspective, we had a very, very low VIX for several years. And, even back in April, it was only about 12.5. So back in 2008, certainly you saw very elevated VIX levels. But all it is, it's measuring the near term, typically the 30-day outlook for volatility, and it's going to go up when people are willing to pay more for options. Now, it's worth noting that the VIX index that you see on TV cannot be traded. That's what's called a spot index. Or, there's no instruments that you can actually trade it. What people, when they say they're trading the VIX, what they're actually doing is they're using the futures contracts. And that gets a little bit technical because you got leverage there and futures contracts are issued over different weeks or months, or people using options. But again, the options aren't based upon the price of the VIX that you see on TV, the VIX index. They're tied to those corresponding futures contracts. So it gets a little bit complicated and sometimes confusing because what you see the VIX at is different than what the VIX futures are at. But the other thing that happened, I think I mentioned, was somebody said, hey, I heard on TV today that we saw an inversion of the VIX curve. What is that? Okay. You might remember a couple episodes back, I talked about the inversion of the Treasury yield curve. And I'll link to that episode if you want to listen to that. But remember, when you do a graph of, let's say, the 30-day Treasury bill or the 60-day, the 2-year, the 5-year, the 10-year, the 30-year, what you do is you just plot on a graph all of those interest rates on those corresponding maturities. And typically what you'll see is from left to right, you'll see a curvature up, meaning the long end of the curve, the longer duration bonds have a higher yield than the shorter end. What we've seen recently is some of the shorter dated maturities on bonds their yields have gone above, let's say, the 10-year yield. And that's called an inverted treasury yield curve, okay? So I'll of course, link to that if you want to brush up on that and learn a little bit more. Did, I think, 2 episodes on yield curves. But the VIX curve is simply, it does the same thing. It plots a number of prices, but instead of using treasury yields, what it does, it looks at the price or the price level of all these VIX futures contracts going out, current month, next month, following month, a year out, something like that. And it plots the same thing. It draws a curve. And typically, the nearer month VIX futures contract in a, let's say, normal environment, you'd expect that to be a little bit lower than the back end. There's a number of reasons for that. But one of the things we saw today as volatility spiked up a bit as the market retraced, roughly 2% or so, at least at some point during the day, is the front month actually went above, I think it's the second month, or so you had a little bit of an inversion, but nothing like you had, let's say, in 2008. So I'll, of course, link to that if you want to get a historical perspective. Okay, so the VIX Index is really what you see on TV, but when you're looking at underlying assets, meaning a stock or an index, that's where we get into something called implied volatility. And so this episode is going to be a little bit more detailed, and I'll, of course, give you some links and things like that if you're interested in learning more about implied volatility or the option Greeks and things like that. But implied volatility, think of it this way. It's, when an option gets priced, options are a derivative of an underlying. And so there's calls, there's puts, right? And those prices are based upon how much time until expiration, interest rates, things like that, how far away the option is, its price or its strike price from where the current underlying is, meaning is it in the money, is it out of the money? But implied volatility is sort of this expectation of how wide a range, an expected range of an underlying asset, let's just say a stock is. And to give you a little perspective on this, let's say that you're looking at something and it has an implied volatility of 10. Okay, what does that mean? Well, 10 is actually, that's fairly low. I mean, what's low? It's all relative, right? But an IV or an implied volatility of 10, to kind of translate that into what the options market, when we say implied volatility, people are sort of betting or placing doing investments, and markets are really a study in supply and demand. So we say when the options market, it's really what the collective traders on the market are willing to pay for options and what their expectations are. So let's say a stock has an IV or an implied volatility of 10. What does that mean? Well, there's a little trick that you can do to try and get, let's say, the 1 day expected 1 standard deviation move based upon how the options market is pricing its options. And that implied volatility with that one number, you can do a lot of things. And so there are typically 252 trading days in the year. And when I say 252 trading days, that's 252 days that an underlying asset can move if you are the buyer or seller of an option. And one of the tricks that you do here is you take the square root of 252, and that's 15.874, and then a whole bunch of numbers after that. So just kind of rounded to 15.875. And when I first learned this, people used to say, don't do 15.875, just round it up even more to 16. Because, that's just, it's easier to do. And as you see what I'm going to do in a second, it might be easier for you. But I'll go with the 15.875. And so if I've got an implied volatility of 10, what I can do to get this expected, at least what the market is sort of expecting based upon its pricing for a 1 day standard deviation, I can take the implied volatility of 10 divided by the square root of 252, which is 15.875, and I get 0.63. So it's a quick, back of the envelope way to say, okay, if I've got this underlying asset and I've got this this implied volatility number, what the options market is saying based upon that implied volatility is, the expectation that, let's say, the market's closed. Let's say tomorrow the market on this stock, whatever it is going to be 0.63%. That's the one standard deviation sort of range, right? Okay, doesn't know higher, it doesn't know if it's going up or going down, but that's the range. And so you might say, well, that's interesting, but don't people sometimes do options not just for a day? Well, of course they do, right? One day wouldn't be a lot of time until expiration. And so the trick to translate that one-day number into, let's say, you're looking at options or you're looking at a stock and you're saying, hey, what are these 50-day options or 49-day options? Well, the second step would just be take that 0.63 and you multiply it by the square root of the time that you're looking to evaluate. And so when I do this, I choose a number that has an easy square root. So the square root of 49, for example, is 7. But if not, you get a calculator out. So if I take 0.63 times the square root of 49, which of course is 7, then I get 4.41%. So basically, with an IV of 10, I'm saying over the next 49 days, the 49-day expected one standard deviation range based upon this implied volatility, which could be right or wrong. It's not certain. It's just based upon the pricing. You would think, one standard deviation range, about 4.41%. Okay, so let's back up a second. What we're saying is there's this number called implied volatility, and the options market sort of puts an expectation of future volatility, and they price the underlying or the options, the calls and puts, based a lot on what the expectation is for future movement, right? If you think something's going to move a lot, it's going to be a little more expensive to buy or the options, right? If you think there's going to be no movement at all, well, no one's going to buy an option that's, a really far away move from the current price. Those are going to not have a really big premium in them. So we take the square root of 252, we get that 15.875. You can also use 16, right? But you can, once you have the implied volatility, in our example, we took 10 divided by 15.875, and that's 0.63. If I want it, and that's the one standard deviation range. If I want to get a range over a number of days, out in time, I take the square root of the number of days. So if it's 100, you take the square root of 100. If it's 49, take the square root of 49, which, by the way, is 7, right? We should know that. And we came up with 4.41. One of the things you should take from this is that if, let's say, implied volatility is much higher, if it's much higher, the option is going to be priced higher because there's an expectation of possibility of a wider move, a wider range of a move. And so this brings us to earnings. A lot of people look at earnings and if you follow stocks, like I said, it's 4 times a year. It's like Christmas for you. So if you follow a stock and you want to know, although the company gives guidance and you've got analysts making recommendations or predictions, or they're doing their analysis and they say, hey, I think they're going to get X number of cents per share or dollars per share. This is the 4 times a year that it's really new information. So whenever you have an earnings announcement, if the earnings are far above the expectations or far below the expectations, or there's something in the revenue or the forward guidance, there's any number of things that could be a little bit unexpected, and you could see a shift in sentiment on the stock. And so depending upon the stock, it could move the stock quite a bit. And so to give you an example, there was a stock, and let's just say it's a more volatile stock. It's a higher beta stock. And I went back and I looked 1 day or 2 days before earnings, its implied volatility was 300. Now remember, at an implied volatility of 10, that's a 0.63 one-day expected one standard deviation move, right? Remember the bell curve, most grades are within 68% of the time, most grades are within that little cone, and I'm raising my hands and trying to form the cone right now. Well, 0.63 was a 10. An implied volatility, or IV, of 300, which is actually a level that I saw on a high beta tech stock right before its earnings, that would imply a one standard deviation move of about 18.9%. 18.9%. And so what it's saying is, hey, the options market is pricing in a move of close to 19%. You may not know which direction, right? But it's pricing that in. And this gets back to the other question. A lot of people new to options, one of the things typically they get excited about is say, wait a second, there's this trade, there's this strategy that I can buy a call and buy a put and do what's called an at-the-money straddle. So imagine a stock is, $370, and you say, hey, earnings are tomorrow, and I think earnings are going to drive the stock. One is buy something that I don't care which way it moves. As long as it moves, I can, maybe do okay on this. Well, here's the challenge with this. And I like to give the analogy of, imagine if you put one of those plastic red cups on a pole, and imagine the top of the pole, maybe it's, one of those cylinders, right? That they put so you don't drive up on the sidewalk. But imagine you put this red cup that's light on top of the pole, and you say, hey, I think we haven't had much wind, but I think it's going to be windy tomorrow. And so I don't know what direction it's going to blow, but I think it's going to blow off there. And let's say my options are, 1 foot to the left, 1 foot to the right. And as long as it goes more than 1 foot, well, great, I profit from that investment. Okay, maybe this analogy is not working. But the point is that you think it's going to be windy, but you don't know what direction. Here's the thing, though. What if they were pricing that underlying, the cup blowing off the pole, and you knew in the weather report it was going to be 20-mile-an-hour winds? Well, certainly if somebody was doing something on an investment like that, you would have to pay up because the expectation was it's going to get blown away and further away from the pole. And so the straddle is a trade. Maybe I did a good job with that analogy. Maybe I didn't. I came up with that on the fly. I probably should have planned that more, but hopefully that was constructive. But the straddle is the idea of somebody buying a call, buying a put. So I'll give you an example. Let's say you've got an underlying stock and you've got, a stock that has an expiration or an option that has an expiration for 24 days in the future. And the stock is trading at, 370. Call it XYZ. I don't think XYZ is a real stock yet, right? So XYZ is trading at 370. And you wanted to buy a call, meaning you want it to go up, or buy a put, meaning you want it to go down. And those are priced evenly, conveniently for our math, at $13 each. And so you can kind of see if you buy the call and you buy the put, well, you spend $26, right? If the stock's at 370, that means in order to make any money on the upside, you'd have to have it go more than 396. In order to make money on the downside, it'd have to go more than $344 to the downside, right? So it'd have to go to 343 and some change, right? Or 396 and some change to actually be above your break evens. And so the reason why I bring that up is this idea of the straddle of I don't care which way it goes as long as it goes. Well, the thing is when earnings come out or when there's a big move expected, I remember, I can't think I can find it anymore, but Martha Stewart, her sentence was being announced or whether she was guilty, and the implied volatility on her company stock was through the roof because people didn't know what was going to happen there. So, this is sort of priced in, and somebody doing a position like this, unless the market's wrong, typically the market's pricing in an expected move. And so to kind of bring it back to our example on the implied volatility, this stock, right, it says 24 days to expiration. Let's say it's got a 34 implied volatility. Okay. So what we would do is we take the 34 divided by 15.875, and that tells us the expected move one day, one standard deviation, is 2.14%. Over the next 24 days, doing the math, it's about 10.5%. And so this stock basically is, pricing in that type of an expected move. Again, you don't know which way. And so don't take that and say, well, how come the options aren't $40 or so. Remember, it could be up or down. But I just bring this up because every once in a while, somebody asks me about the idea of option strategies and what they might be telling us about the market. And there's a couple things here. Number one is this is a trade that's a little more advanced than it seems because it's really a play on implied volatility or a volatility-based trade. And stock has to move quite a bit if you're going long this. But also the market already knows that potentially there's going to be a move on an underlying security. And if the expectation is for a big move, its options are going to be pricing in that expectation, okay? The other thing is you can look, and it is constructive if you look at the implied volatility right before earnings, you can actually see how much bigger that is depending upon whether it's something that it's believed to be moving quite a bit. I can't remember the numbers on it exactly, but one of the great examples of really high implied volatility, there were some Canadian dollar futures and options on the futures, and there was this thing called the succession vote, whether Quebec was going to secede from Canada. And I remember the implied volatilities were really, really high. And that was something that, was pointed out to me by a number of really seasoned options people back in the day. So, all right, well, that's a little bit of a primer on VIX, implied volatility, and how you can take implied volatility and do a little bit of math and see what the options market is expecting over a period of time for a one standard deviation move. And so this got, as I said, a little bit more involved, but I get questions about this, and so I thought I would cover it. I'll, of course, link to the website I mentioned that you can take a look at the term structure of the VIX futures curve. I'll also link to the Treasury yield inversion piece and podcast that I did. And one of the things that's been helpful, those of you who have reached out to me with suggestions on episodes, you can go to razorwealth.com and message me on the site and let me know if there's a topic or something you think would be interesting to cover. And of course, instead of wasting your time saying, hey, rate and like and do all this, do me a favor. If you find this valuable, continue to share it with friends or colleagues because that's how we can grow this audience a little bit. And I appreciate it. All right, we'll see you all next week.